Well, the news out of Russia has led to some swings in the currency market as well. Take a look at where the euro is rebounding against the dollar right now at about 1.13. We saw the dollar index, meanwhile, pulling back against those gains we saw yesterday on the back of news yesterday again that violence could potentially be escalating in the region. To break down the latest moves in the FX market, let's bring in Emily Weis, State Street macro strategist. Emily, good to talk to you today. What are the moves we're seeing today suggest to you in terms of how much of the worst case scenario has actually been priced in already?
Yeah, it's really been an interesting few weeks here where we've been stuck in this sort of push and pull of geopolitical headlines. And geopolitics is one of the hardest things to trade as a trader perspective, just because there's so much uncertainty involved. So as you noted, today we have out new headlines that are suggesting maybe an easing of tensions comes on the back of Friday when there was a repricing in terms of potential military escalation, et cetera. Now what really comes down to is just sort of teasing through the headlines. And unfortunately, there's a lot of headline risk in this scenario. As we see in the moves today, things are reacting very quickly. We do have the ruble still weaker on the year, but only about 1.7% weaker versus the dollar, which is well off the highs of where it was at the end of January. So as much as the market is still pricing some risk premium there, it certainly isn't pricing the worst case scenario. And that is something to sort of keep an eye on as we head forward into following additional headlines.
Hey, Emily, it's Cheung here. Great to have you on the program. I mean, how much of this is also tied to the picture on oil? Because obviously, when we talk about the market implications, that seems to be where people gravitate to very closely. And we know that the ruble does have a relationship with oil very closely, given the importance of energy to the country. In fact, you point out that the last time the ruble was this underweight was when oil prices, it feels so long ago, but we're at $40 a barrel.
Mm-hmm. Yeah, no, it does tend to really closely follow the oil price movements. And if anything, this year so far, we've actually seen a pretty bullish cycle for commodity markets. The geopolitical tensions added on top of factors that were already in place over supply and demand imbalances from the pandemic. So we still were already seeing heightened commodity prices, and then that obviously has further gotten investors sort of sucked into this ruble trade. Additionally, these kinds of sanctions and political risk are always sort of hovering in the background. For people who closely follow Russia, this is certainly nothing new. What is different this time is just the potential for a much further escalation that could have economic consequences by way of sanctions, which there are a range of options. So I think right now there's just a lot of things on the table. Commodity prices are one, but actually that's been a net positive for EMFX so far this year and for the ruble. So that's been interesting to watch, particularly if there is an easing in tensions. We would expect to see the ruble snap back pretty significantly.
Emily, I wonder, to what extent we're going to continue to see the choppiness around the headlines, as you mentioned. I mean, today it seems like a significant pullback, even though we don't have a lot of details about what exactly this withdrawal means. In the meantime, you got the Russian parliament today voting to declare the Donbas region independent. I mean, it feels like there's a lot of things that are layered on here in what's playing out in Russia. And I wonder to what extent the market is fully pricing in this risk. If it's not military action, it doesn't necessarily mean that Russia is not going to move in on Ukraine further.
Yeah, as I mentioned at the start of the program, geopolitics is one of the hardest things to trade, just because you're subject to an evolving situation that honestly no one really has incredible insight into. We can do our best to try and predict the next moves, but it's really hard to figure out the most probable outcomes. So in our situation, that means evaluating where the potential pain points could be in terms of where investors have already built up positions and where we're seeing the price action show that maybe there isn't as much price in as there should be. And then on the second hand, evaluating all the different outcomes that we could see fall out of this. So not just is there a military conflict or not, which for us, it focuses primarily on the financial implications, but then following it one step further to think what could the U.S. Treasury response be in terms of foreign ownership of OFCs or Russian bonds, or what could the implications be for access to the SWIFT payment system? All those sorts of questions are important to think about, and they're really hard to price. So right now we are sort of subject to this push and pull until we have additional outcomes. The one sign of encouraging news for me is just that there hasn't been too much of a contagion effect from this Russia story and Russia-Ukraine story at the moment into both either other areas of EMFX or even into the broader market sentiment. So while we still have seen some fluctuations, it isn't yet something that seems to have a major market systemic risk factor.
That's a really interesting point that you bring up about kind of how you haven't seen the spread to other EM, especially given the time in the cycle when everyone's been talking about EM and how undervalued they've been through the recovery. But I guess, how do you pair that with the tightening cycle that we're seeing around the world in other emerging market countries? Like if you think about the BRICS countries, Brazil, for example, one of the earliest to start hiking rates. How does that kind of also factor into the risks either on the upside or on the downside of getting into EM now?
Yeah, Brian, I'm glad you brought up monetary policy because it's been the key component we've been watching, not just from the point of view of the Fed, which we're now pricing significantly more Fed rate hikes coming up this next year, but also from the view of emerging markets, which have broadly led this cycle in the terms of removing policy. So actually places like Brazil are coming up towards the end of their easing cycle, just as the Federal Reserve and the ECB are starting to talk about getting started. So it's actually been a bit different this time around. We haven't seen the same sort of exodus from EMs that we might have expected alongside a tapering scenario. Certainly was not a repeat of the taper tantrum. If anything, it was almost the opposite in terms of we had EM FX outperformance in this environment. So those unsynced monetary policy cycles are actually benefiting at the moment some of these emerging market countries where rates are in Brazil above 10%. And that's pretty significant at a time when inflation is just starting to peak in that country.